and they should have raised rates by 1 full percentage point in January of 22. Instead, they did not. They rose by 25 basis points, and they took it nice and slow because they didn't want everyone to get nervous. And God forbid, that was a mistake.
So, hi Ken, it's a pleasure to talk with you during this time. It's a pleasure, and thank you very much for this chat.
My pleasure. Happy to have this discussion with you.
So, first of all, I want to focus the talk on your career and then on the current moment in the markets. To begin with, why did you start in financial industry?
Because it was by a sheer mistake, right? I wasn't, it's not what I wanted to do when I was in college. I went to school in Washington, D.C. I wanted to be a lawyer and a lobbyist and a politician and ultimately the president of the United States, which thank God that never happened. But while I was in college my freshman year, I had the opportunity to go and be an intern on the floor of the New York Stock Exchange, which I had never been to. I didn't know anything about it. I didn't know what stock was, a bond was. I didn't know an eighth of a quarter. I knew nothing about the stock market yet. I had this opportunity to go and spend the summer in New York City and go work there. So I debated it during my freshman year in college. And then I decided that, okay, let me try this. What's the worst that's going to happen? I'm either going to go there and hate it and I'll put it on my resume and just move on, or I'm going to go there and it may change the course of my life. If I fell in love with it, it may change the course of my life. And in fact, it was clear I was there for about 5 weeks and it completely changed the course of my life. That experience I had as a 19-year-old student at the floor of the New York Stock Exchange, doing nothing other than, running errands and like you do when you're 19, when you don't know anything, you're a gopher, right? You go for coffee, you go for this, you go for that. But I was just so taken in by the energy that was on the floor of the exchange and the excitement. And every day it was amazing. There were 5,500 type A personalities running around the floor, screaming and yelling all day. It was a very, very exciting place to be. So I went there. I was there in the summer of 80, the summer of 81, I went back. The summer of 82, I went back. And the summer of 82 was when the bull market was born, right? That great bull market that we had for 25 years from 1982 to the turn of the century was born in the summer of 1982. Ronald Reagan was now president. We had just come through the Jimmy Carter years. The country was in a disaster. We had the Iranian hostage crisis. We had the oil embargo. We had high inflation. We had high unemployment. It was horrendous. Anyway, so Ronald Reagan was now president. He had passed his Reagan tax reform package. The economy started to turn around. Rates started to come down. And thus was born the greatest 25 years of U.S. growth, and I would argue global growth that the world has ever seen. And I was right there. I was a 22-year-old kid right out of college. I just happened to be in the right place at the right time. And when I graduated college and came back to work there, I honestly thought it was going to be a 2 or 3 year stint, right? Because I'm from Boston. I'm not from New York. And I just figured I was going to go and get some experience and then move back to Boston and get a job in Boston and live the rest of my life in Boston. And in fact, when I went back there in 1983, the markets were just booming. And I ended up meeting my wife on the floor of the New York Stock Exchange. And my wife's story is actually very interesting. She was a kid that grew up in Brooklyn. She's Puerto Rican, so she's of,
really?
she's of Hispanic descent, and she started there as a runner, and she worked her way right up the ladder as well, and ultimately became a member of the New York Stock Exchange in 1984 when there were a dozen female members, and she was the first Hispanic female member of the New York Stock Exchange. So I got my seat in 85, and then we got married, and the next thing you know, 40 years goes by, right? And the life just happened, right? So I lived through all those events, right? The birth of the bull market, the crash of 1987, the technology boom of the 90s in preparation of Y2K, and then the dot-com bubble that happened in, 98, 99, 2000, and then the turn of the century, which was, a massive undertaking, and then the modernization of U.S. markets and the use of technology and handheld technology and technology in general. And then the events of 9/11, which then changed the whole dynamic of the U.S. capital markets, how we use technology versus how we were using technology, and the need to secure and stabilize the U.S. markets after that event, because no one in their right mind could have even envisioned an event like that. But the truth was, here we were, the largest capital markets in the world, right? When you think about Asia, Europe, and the U.S., the U.S. is by far the largest capital market in the world, and we got taken out, right? That event brought us to our knees because we were trading on the floor, face to face, pen to paper.
With papers,
we weren't
right?
we were not using, Asia and Europe had already modernized. They were already using technology. They did that back in the late 80s, early 90s. We waited until after the turn of the century. And then when we started to modernize, then 9/11 happened. And what that did was it raised the concern that here we were, the largest capital markets in the world, and we were still operating in one single location in downtown Manhattan with 5,500 people with not a lot of support. There was no backup plan. There was no backup plan then. There is today. After 9/11, that's created backup plans for everybody as a backup plan now, right? In the event that something like that happens. But at that time, there was none. And so the country was brought to its knees for, 6 days. Until we reopened, and then we regrouped, and then we started to move on. So then I lived through that, and then I lived through the exchanges going from private ownership to public ownership, right? Because the New York Stock Exchange is now a publicly traded corporation. Prior to 2005, it was not. And then the great financial crisis, which lasted for, as far as I'm concerned, 5 years. I think the crisis started in 2007, and it didn't really feel very comfortable until we got to somewhere around 2012. And then I lived through that whole, the last 10 years have been a kind of an interesting ride with central bank policy around the world, with Fed policy here in the United States, and zero interest rates, and in Europe they're negative interest rates, and investing alternatives. And now here we are today.
What a career! What a career! It's full of full of events, right?
It's full of a lot of events, and I've been in this business for 40 years, and so there are a lot of events along the way, and I can say that I lived through all of them, right? I mean, I didn't even talk about what was going on geopolitically, right? So the wars in all the different wars in Syria and then Iraq and then Afghanistan, and now, Russia, Ukraine, all that geopolitical stuff, which also gets tossed in there on top of all the central bank and monetary and economic stuff that creates, the vibrant market that we have today.
And talking about your experience, what is like to work on the Wall Street trading floor? Is there a lot of stress right now? You mentioned
it was well today, no, because so much of it is done electronically, right? Today, remember I said when I went to work there in 1980, there were 5,500 Type A personalities running around the floor. Today, there's less than 150 people that manage the trading that we used to do with 5,500 people. There's now less than 150 people that do all that trading, because it's the technology then that allows all that to happen. So the experience today on the floor is very different than the experience I lived for a good 35 years, right? With all the people there. That was a very different experience. And at the time, like if you had asked me, was it stressful? Was I stressed out? I was never felt stressed out, partly because I think as a Type A personality, you feed on that energy, right? So you're not necessarily stressed out. To this point, I never felt like I was stressed out. There were days that were exhausting, mentally exhausting, but that's different from being stressed out, right? I used to love to go there every day. I used to love the energy. I used to love all the excitement because one day there were never 2 days that were the same, right? Because the news was different, the stocks were different, the action was different. Was it being driven by geopolitical stuff? Was it being driven by economic stuff? Was it being driven by earnings? Was it being driven by policy? So it was always, always, always a very exciting place to be. And I loved every minute of it. I loved every minute of it. But today, it doesn't exist anymore in the way that it did. The New York Stock Exchange continues to exist, and that will continue to exist, but it has transformed itself, right, with technology. So now when you go down to the floor of the exchange, the bell rings at 9:30. By 9:35, there's a hush in the room because there's no more open outcry. People aren't running around screaming and yelling anymore. It's all done by computers. So it's all very quiet. And so everyone down there today is a type B personality, right? They sit behind their desks and they're on their computers all day and they're not, they don't have that type A personality.
Yeah. I want to ask you maybe a controversial question. I don't know, but in many films, in many movies, the world of Wall Street in the past is portrayed as a sector full of excess, What is like in the past and what it is like now? In this sense.
So, during the 80s and 90s bull market, excess is what you said, right? Full of excess. Is that what you said?
Full of excess. Okay. Yeah.
Right. So I will say that certainly in the penny market, like you saw, like that movie, The Wolf of Wall Street, right? The Wolf of Wall Street was all about penny stocks and penny stock trading. That was not my world. That was not the world I lived in, right? And so therefore, that world was very much like it's depicted in the movie. There was huge excess in that market, right? Now, in my market, was there excess? There was a bull market that created lots of opportunities. So, there were always dinners and there were always concerts and there were always golf events and always things you were doing and traveling around the country to go take clients to golf and take clients to sporting events and concerts, all that stuff. So I don't know if you consider that excess or if you just consider that at the time, that was the way business got done. And because the market was so strong and the economy was so strong, that was all very much a part of it. But like when I think about the Wolf of Wall Street, for instance, I actually get offended when people say to me, "Oh, you're just like the Wolf of Wall Street." No, I'm not like the Wolf of Wall Street because that was not my world. I didn't do the drugs. I didn't do that world was a very different world.
A small world, maybe a small world, no, a small one.
Well, I mean, it was small in the sense that it was penny stocks, but it was because the penny stocks were so illiquid. People that traded those penny stocks, people in the brokers in the business that traded those penny stocks, could make a lot of money because they would make aggressive bids and offers and try to get the business done. In my world, on the floor of the New York Stock Exchange, you didn't have that opportunity because the market structure is such that, all these are well-capitalized names. There's volume right in line. You're not making ridiculous bids and offers. Do you know what I mean? So while it was all very exciting, and it was very exciting, I never found it to be obnoxiously excessive in anything. I enjoyed myself. There were nights, there were weeks when I was out to dinner every single night, eating at the finest restaurants and having the finest wine. Yes, that happened. But you were entertaining clients, you were taking people out. It was just what the environment, allowed at the time. Today, it's not like that at all. Partly because regulation, after it was probably early 2000s, they put in the industry put in new regulations about what was appropriate and what was not appropriate. Because, if you're one of my clients and I take you out and I spend $5,000 on you and I fly you to Las Vegas and we spend 2 nights in Vegas and I pay for everything and then bring you home, the sense was, the argument was, well, Kenny's just buying business from Hector. He's going to pay all this money, and Hector's going to,
Yeah,
Hector's going to give him all kinds of business as
I
a
understand.
payback.
Mhm.
Now, so the industry then came in and regulated, says, listen, you can't do that. You can no longer fly Hector out to Las Vegas and pay for his airfare, and pay for his hotel, and pay for his gambling. You can't do that, right? And so therefore, a lot of that no longer exists. Now, doesn't mean that people aren't going out to dinners. I can certainly take you out to dinner, but it can't be excessive,
Yeah,
right?
yeah, yeah. Right.
Um, and so I actually think that was a good. I think that was good that they did that. They took some of the excess out.
Mhm.
Um, because listen, when let's be honest, when times were good, when people were making money hand over fist, there could be those kinds of excesses, right?
Yeah.
Where I'd say to you, come on, we're going to go golf. I'm going to take you down to the Caribbean to go play golf for 2 days and then fly you home on a private jet. That kind of excess was
Yeah.
certainly it certainly existed, but not for the masses, right? That was for the
Mhm.
few.
Yeah.
But that doesn't that you'd be hard pressed to find that kind of entertainment going on anymore because the industry frowns upon it and the regulators frown upon it, and you can't get away with it anymore, right?
I think it's pretty clear, right? I think it's pretty clear. So,
Yeah.
talking about the current environment, do you
Yep.
think that what has happened with Silicon Valley Bank has similarities with what happened in
No.
2008 with Bear Stearns and Lehman Brothers?
No, no. It was two completely different events. Bear Stearns and
Mhm.
Lehman Brothers were international investment banks
Mhm.
that had their tentacles out really around the world, right? Silicon
Mhm.
Valley Bank did not. It was a private bank here in the United, well, not a private, it was a public bank, but it was here in the United States. They serviced a very specific community, the startup venture capital, private equity community. It was very incestuous. Lehman Brothers, it was real estate, it was mortgages, and Bear Stearns was real estate, it was mortgages, it was all this stuff. And when they imploded, that implosion, spread around the world very quickly,
Yeah.
and brought the whole system down. And then on top of that, but a lot of those products, those mortgage products that had been designed, to take advantage of all the good times in the economy, were really purchased by investors around the world. So when they imploded, investors around the world got taken down. That's not what happened in Silicon Valley Bank at
Mhm.
all.
Mhm.
And so therefore, there is no
Either
comparison between.
Credit Suisse, it's not Lehman Brothers too.
No,
Credit Suisse.
Credit Suisse. Credit Suisse is another issue on its own. Look, for as
Yeah.
long as I've been in this business, Credit Suisse has always had problems. They've never
Mm.
been able to get it right. Yet they've always seemed to kind of make it through, right? It was
Yeah.
also Credit Suisse was a Swiss national treasure, and so the Swiss were not going to let Credit Suisse go by the wayside. They just were not. This time, though, I guess the situation was tough enough that they had to, they tried to come to the rescue. They tried to prevent the run on the bank. They tried to do all that, but I think it just spun out of control. I don't think the Silicon Valley Bank issue helped it. I actually think it added to the angst in Europe, with Credit Suisse, but ultimately Credit Suisse honestly needed to get taken over. They should have gotten taken over years ago. And
Mhm.
so, the Swiss got
Yeah.
together with the other big Swiss bank and created now a new big Swiss bank, right? That the Swiss will end up supporting and keeping, and it will become the new Swiss national treasure. But I don't think Credit Suisse is not a Bear Stearns Lehman moment.
Mhm.
I don't think so.
Um, Related with that, do you think we could discard a financial crisis right now, or just a cyclical crisis with the current environment? Or
So, I do not define it as a crisis. Do I think that there's going to be volatility ahead? Yes. Do I think that, central banks around the world kept stimulating and kept rates way too low for way too long?
Mhm.
And so therefore it has now created this crisis. I think for the most part, you can pin the blame probably 60% on the central banks, and I'll be the first one to say the Fed is right up there, because I think the Fed missed the boat. I think they missed the opportunity years ago, like in 2018, 2019, to start to raise rates very slowly. They certainly missed it in 2021 when inflation zoomed up through 1.6%, right up through 2% like that, when they told everybody that 2% was going to be their bogey. The minute it went through 2%, they were going to change policy. And in fact, they did not. They continued on that policy path with zero interest rates and plenty of stimulation throughout 2021, even as inflation was soaring higher. And they told everybody not to worry. So I blame the Fed for a lot of this. Had they listened to their own narrative, this should not have happened. Yeah. And then when they ultimately decided to start raising rates in January of 2022, they also, in my opinion, missed the boat. And I said it then in January 22. I'll say it again now. They should have come out of the gate and they should have raised rates by 1 full percentage point in January of 22. Instead, they did not. They rose by 25 basis points, and they took it nice and slow because they didn't want everyone to get nervous. And God forbid, that was a mistake. They should have really grabbed it by the balls, and they should have raised rates by 1 full percentage point right out of the gate. They should have shocked the markets a little bit. And then I don't think we would be in the situation we are today. We're in the situation today because they didn't do that. They tried to play nice in the sandbox. They completely missed the whole inflation argument. And then they fell behind the 8 ball. They're still behind the 8 ball, which is why now it's getting even, a little bit dicier and more volatile because, they pushed the markets up higher than they should have been. And so now as they start to raise rates, markets are going to reprice. Absolutely. And they're going to come in. Do I think it's the end of the world? I do not. Do I think there's going to be some more volatility and potentially some more chaos in certain names? I do. But for the most part, I think that the system is fairly stable. And if you just allow the system to work, it will price the risk properly based on everything it knows, right? Because here's what the market wants. The market just wants clarity. Whether the clarity is good news or bad news, all the market wants to know is, what's the news? If it's bad news, then I can adjust. If it's good news, I can adjust. What it has right now is confusion. Yeah. And so therefore, that's why you have this, right?
I make you just the last one because I know your time is limited. So, are you concerned about the volatility being seen in the bond market?
Yes, I am concerned about the volatility, but again, I am concerned, but I'm honestly confused because there shouldn't necessarily be all this volatility in the bond market. It's not like the Fed has not been clear. It's not like they have not been transparent. They've been telling everybody for a year before they raised rates and then the year while they're raising rates what they're doing at every point. Rates are going higher. The data's getting hotter, so we need to remain aggressive. They've been saying it all along. And so therefore, what I think, if you want to know what I honestly think, I think that there's a generation of investors, quote, or portfolio managers that don't know anything other than 0% interest rates. So think about this for a moment. I was alive in 1978, 79, 80. The last time unemployment surged up to 13% and rates went up to 22% and inflation was running at 10%. I was alive. I lived it. I did it. Some of the people today that are in this market who came into this market, say, during the crisis in 2007, which was already 15 years ago, right? They came into this market, maybe they're 25, maybe they're 27. So now they're 40. And all they know for the 15 years is 0 rates and 0 inflation.
That's true.
So now suddenly it's not 0 rates and it's not 0 inflation, which is exactly what happened at Silicon Valley Bank because they serviced a very specific clientele. It's beyond me that they didn't understand this. But they serve the clientele in the startup business. And startups and venture capital firms are always using money. They're not depositing money. They deposit it, but then they use it, right? And so therefore, anyone at Silicon Valley Bank that took that excess money and they invested it to try to, hedge their, to invest it, to have it work for them, they invested it in long duration bonds. Why would you invest in long duration bonds at a bank that services a very active community and lock yourself into rates that are 1.5% when rates are rising? And they're rising because we told you they're going to rise every month. every month at every meeting, rate's going to go up. So you lock yourself into a long duration portfolio. Okay, you didn't even hedge yourself. You didn't even protect yourself from that, right?
That's a mess.
And so
No hedge,
therefore,
no hedge these bonds. That's absolutely mess and a huge mistake.
Because listen, there are a lot of banks, and by the way, insurance companies out there that have long dated portfolios that are only paying 1.7 or 1.8%. But guess what? That matches what their demographic is. So they're matched. They're not mismatched. Silicon Valley Bank was completely mismatched. They apparently didn't have anyone at the bank that understood a rising rate environment. They had no chief risk officer. They had nobody. They had the inmates running the asylum, right? And it was ridiculous. And so therefore they create that. Then they, through the use of social media, all you need is this phone, and you can move money like this, right? Through the use of Twitter and LinkedIn and emails and all that stuff. Then they start lighting the place on fire. They start sending out emails and tweets and social media. Oh my God, take your money out, take your money out. Well, if you tell me to take my money out, I'm going to go like this on my phone. I'm going to take my money out. Yeah. That's how easy it is to take my money out. And so they created this own hysteria and the chaos. Which I think is a whole nother conversation, and we could talk about that at another time. But I think every single one of them, every one of those VCs, every one of those guys that created this area, they should go in there and rip open their trading accounts. They should see how they were positioned. Did they benefit from a collapsing banking sector? Do you understand what I mean?
Yeah, absolutely.
Okay. So I actually think that they need to go in and rip all those books open and see who was positioned how. But that's a whole nother conversation. But I also think part of it was also you have a bunch of people that had no experience on how to manage risk in a rising rate environment at a bank that had a very specific clientele. Because you have plenty of other banks that have the same, all these bond portfolios are underwater if you were forced to sell it. If you're not forced to sell it, it's not a big deal. You live in your house. You bought your house 2 years ago. You paid $1 million for it. Today, the house is only worth $800,000. You're underwater if you had to sell it. If you don't have to sell it, guess what? You're not underwater because you never realized the loss, right? Yeah. So you rode the cycle because 5 years from now, your house is going to be worth $1 million again or $1.2 million. Then you're going to sell it. You're going to walk away. But right now, if you had to sell your house, are you going to lose money? Of course you are. Same thing happened in that bond portfolio. They were forced to sell it because the flamethrowers created chaos. And that's how that happened. And so I think they should all be held responsible, if you want my opinion, because I think it's bullshit what they did.
So, Kenny, thank you very much for your time. I know that you have to do another thing. So thank you very much for your time. It's a pleasure to have a conversation with you, and I invite you another time to come with us and to share your opinions about stock markets.